Hello everyone, welcome to another episode of In Conversation by Advisor Coach. Today in conversation, our guest is Mr. Sharwan Goyal, Fund Manager Equity, Head of Passive and Quant Strategies of UTI Mutual Fund. Welcome Sharwan to In Conversation by Advisor Coach.
Thank you, Sharwan, for inviting me. Thank you
Our
so much.
pleasure. So Sharwan, just to begin with, could you tell our viewers about yourself, about your investment management journey and experience?
Sure. Sharwan, I'm Shravan Goyal. So I've done my MBA and as well as CFA charter holder as well. So I'm with UTI for last 18 years, wherein I have worked across investment functions such as risk management, portfolio analytics, as well as fund management. Currently, I'm heading a passive vertical as well as managing quant and arbitrage fund. Um, uh, so in the sense, overall, we are managing close to 1.5 lakh crore worth of passive funds across 20 odd funds. And in the sense, along with the passive vertical, I'm also managing equity portion of UTI multi-asset allocation fund, which we are managing in similar fashion, which we are going to discuss about UTI Quant Fund.
Sure. So Sharwan, absolutely, like you mentioned about UTI Quant Fund. So UTI Mutual Fund have launched their NFO on 2nd January and closing on 16th January of UTI Quant Fund. So very eager to know in terms of, what kind of factors are you considering in this portfolio? What kind of weightages are you looking to assign to these factors? And how have these factors generally done, in the broader markets if once you did your back testing?
Sure. So then, rather than looking at traditional way of investing, wherein stocks are selected based on business fundamentals as well as sectoral allocation, in this particular fund, we have identified market cycles using factors. We have seen that different factors tend to perform well in different equity market cycles. And generally, performance gap across these factors tends to be extremely huge. So, for example, in last 4 years, there was a very extreme value cycle, wherein value cycle has significantly outperformed any other cycle in the marketplace. So, through UTI Quant Fund, we are trying to identify these cycles, which these factors goes through, and using these factors, we are constructing the portfolio. So UTI Quant Fund has combination of top-down allocation across these four factors, as well as bottom-up stock selection using UTI's core philosophy. So we call it integrated investing approach, wherein we combine both business fundamentals as well as market cycles using these market indicators.
Sure.
Through this particular fund, based on market cycles, we are going to allocate money across these four factors, and that too in a dynamic fashion. So through this particular fund, we are trying to identify medium-term market cycles, and accordingly, we will build portfolio across these four factors.
Sure. And so what has been the performance respective to the broader market segment when you did some back testing?
Right. So in the sense, last 20 years, the factor model has generated close to 24.5% returns as compared to 15 odd percent return for BSE 200 index. In terms of consistency of outcome, in last 20 financial years, 17 out of 20 years, the factor model has outperformed. And generally, we advise to people to look at rolling returns for any particular strategy. So on 3-year rolling returns basis, almost 94% of the time, the factor model is outperforming vis-a-vis BSE 200. So in the sense, it is having consistently high probability of generating alpha versus broader market.
Sure. So the four factors which you will be utilizing in UTI Quant Fund, could you name them and any weightages which you're assigning to these factors?
Sure. So we look at combination of momentum, low volatility, quality, and value. So we use two decision tree. First one is quality value indicator. Second one is momentum low vol indicator. Through first decision tree, which is quality value indicator, we try to determine quality and value cycles. Right. So we studied previous cycles in the global context. So we have more than hundreds of year data, but in Indian context, we have analyzed for last 20 years market cycles. And using those cycles, we have determined that at what particular point in time, one factor tends to perform well. And accordingly, we are allocating money across these four factors. So just to throw some more light in terms of allocation across these four factors, we have seen that across these four factors, momentum is having extremely high consistency because across different market cycles, momentum tend to perform much better on consistent basis, while other three factors are much more cyclical in nature. So that's why we are having up to 100% allocation towards momentum, while other three factors we are capping weight at 70%. So through this particular fund, we are trying to determine next big cycle, which is likely to play out. And currently, our model portfolio is suggesting about 70% allocation towards quality factor, while 21% allocation is going towards low vol, and remaining 9% allocation is going towards momentum.
And is it a monthly rebalancing of these factors, or what's the cycle of the rebalancing?
Absolutely. So in the sense, in terms of determining allocation across these four factors, we are going to rebalance on monthly basis.
On a monthly basis.
Although we are approaching from medium term perspective, but we will keep checking data on monthly basis to determine whether allocation needs to be changed across all four factors.
Sure. And Sharwan, through this integrated investment approach of UTI mutual fund, so obviously there's going to be a fund manager intervention whenever you believe that that is required. To what extent will that be?
Sure. So we call it integrated investing approach because we combine business fundamentals using UTI score alpha philosophy. So wherein we are covering about 430 companies. We have 14-member research team which tracks companies across the length and breadth of large, mid, and small cap, and they cover all major sectors. So there is a qualitative aspect of covering companies, right? So based on companies which are having stable business model, we analyze companies from business fundamentals perspective, and accordingly, these companies are approved for investment across all UTI funds. So once we determine the overall coverage universe, first and foremost, we remove companies which are extremely illiquid or companies which are smaller in size. So we filter out almost 20-25% of the company, and remaining companies, we rank these companies based on those four factors. Once we determine top-down allocation across these four factors using those two decision tree, which are quality value indicator and momentum low vol indicator, the next process is selecting stocks or constructing the portfolio. And for that, we are running these four screens. And then from each bucket, we are selecting best companies. So for example, the model is signaling 70% allocation towards quality at this point in time. So out of 350 odd companies, which are effective universe after removing illiquid companies, we rank all these 350 companies based on quality parameters, like companies which are having high ROE, better debt to equity ratio, and consistency of profit growth. So using these three sub quality factors, we rank all the companies, and then best companies are selected from each bucket. And accordingly, based on top-down allocation, allocation is made across these four buckets.
Sure. So typically, this portfolio have how many stocks?
So overall, we look to have about 50 to 100 companies. So number of companies depend upon how many factors we are allocating money. So let's say if I am allocating money to a single factor, probably number of companies will be lower end of this 50 to 100 range. So whenever number of factors, allocation across number of factors is higher, typically number of portfolio companies will be also higher.
Sure. Sure. And generally, do you believe that this is going to be more a flexi style sort of a portfolio?
Absolutely, in the sense we tend to follow flexi cap kind of approach, wherein we will have allocation across large, mid, and small cap. At the same time, portfolio will be diversified across factors depending upon the decision tree thrown by the model.
Sure. Sharwan, could you also highlight some of the prudential norms which you tend to follow in management of this portfolio?
Sure. So we intend to have a factor neutral, purity approach, wherein whatever model is signaling, we will allocate money across those four factors, irrespective of whichever sector they belong.
Sure.
But in a sense, from risk management point of view, all our thematic fund needs to have certain prudential norms. So the sector weight is kept at either 40% absolute or benchmark weight plus 20%. So in the sense, let's say if IT sector weight in the BSE 200 index is 10%, then irrespective of whatever model is signaling, we will not allow IT sector weight to go up beyond 30%, which is 10% plus 20% overweight. But we believe that 20% is a good enough leeway from portfolio diversification purpose.
Sure. My favorite question, why should investors look at investing in Quant mutual fund? Why should distributors look at advising this product or suggesting?
See, so we know that different factors tend to perform well in different market cycles. So these factors are extremely cyclical in nature, right? Generally, we have seen that investors chase returns, past returns. One should not get carried away by what has worked in last 2-3 years perspective, because cycles keep shifting. So UTI Quant Fund intends to have allocation across all these four factors, which tend to perform well in different cycles. First and foremost, our intent is to identify market cycles and accordingly allocate money dynamically across these four factors. So we believe that UTI Quant Fund is a ready-made solution of allocating money across factors. Investors have two choices. Either they decide which factor to invest at a particular point in time, But we believe that investors face two challenges. A, how to determine how much allocation should be made into a particular factor. Second, in the sense, this particular element of dynamically allocating money across different factors will lead to higher tax incidence as well. While UTI Quant Fund, in a sense, UTI Quant Fund is providing these two solutions to the investors, wherein dynamically allocation will be made across different factors, and that too in a tax efficient way.
Sure. So, Sharwan, through this in conversation today, what message would you like to give to mutual fund distributors, advisors, and investors about quant fund as a strategy? Because typically, if you look at the breakup of our assets of the equity, quant or factor fund investing is not a very large category in our markets, at least at this point in time. Of course, it's growing. So how relevant do you believe is a quant strategy to be there in a client's portfolio? And why should distributors continue suggesting, a quant strategy to be part of an investor's portfolio? What message would you like to give?
So we have seen that different cycles tend to play in different equity market environment. These factor strategies are new in India because in a sense, they were brought in about 5-6 years back in Indian context. But globally, people have analyzed these factor strategies from very long-term perspective. And from longer-term perspective, these strategies have done well from global context. And in Indian context also, since inception, which is from 2005 onwards, all these factor strategies have outperformed. In fact, we have all these 4 factor strategies through our passive platform. So we are offering those options to the investors through our passive platform. But somebody who needs to handhold in terms of allocating money across these 4 factors in a dynamic fashion. So probably quant kind of strategy, which is allocating money across factors, could provide that kind of solution. Overall, quant is a very vast area. Through UTI Quant Fund, we are trying to address some part of quantitative research through these 4 factors. So we believe that investors and distributors should not get carried away by what has worked in the past, because markets goes through different cycles. So in the sense, they need to understand market cycles and then accordingly build client portfolio based on what is likely to perform well in next 2-3 years perspective.
So would you suggest a quant fund strategy to be part of investors' portfolio on a regular basis?
So we believe that it makes sense to have some allocation to these factor strategies, because these factors have done well from longer term perspective.
Sure.
So UTI Quant Fund is a ready-made solution of allocating money across 4 factors.
Sure.
Because here we are trying to identify medium-term market cycles and accordingly build a portfolio across these 4 factors.
Sure. Very well. So, for our viewers, this is Mr. Sharwan Goyal, fund manager, equity, plus head of passive and quant strategy with UTI Mutual Fund, talking about their new fund offer, UTI Quant Fund, which started on 2nd January and closing on 16th of January. So thank you very much, Sharwan, for joining in and taking out time during the NFO busy time and taking us through your UTI Quant Fund.
Thank you so much. Thank you.
Thank you.